Well, good afternoon, everybody. Welcome to another OIC presentation. My name is Marty Kearney, and I am a consultant to Miami Exchange, and I am thrilled to be here to talk to you about options today. And here's the deal. You can download this presentation. You have the opportunity to send questions in. We'll try to get to the questions either in the background, if it's something pertinent just to you. If it's something that would help all of us, people will pass those questions along to me, and we'll cover those during the presentation or at the end of the presentation, or the help desk people at OIC, Bill Ryan and his crew in Chicago, will try to get you the answers either later this afternoon or tomorrow early. So don't hesitate to send questions in. And if it's something pertinent to you, they'll handle that so everybody doesn't see it. But other than that, we'll see what we can get done here. I like selling options, okay? I like buying options. I like selling options. My experience, just for those that don't know, I was an investor for many years back when dirt was new and dinosaurs ruled the earth. I was a floor trader for 16 years. I moved on and was helped run a securities firm for about 18 years as a partner. And then I went on to one of the exchanges and did a lot of education for them and a lot of work with OIC and the wonderful people there. And the people at OIC have no axe to grind. They're not, in particular pointing to one broker or one platform or one exchange or anything. They're there to make this work for you. So why don't we go ahead, let's not waste any time, and let's get into the whole idea of selling options, okay? And here's what we're going to talk about first. You should be aware of this, that options involve risk. If you would like a copy of the options disclosure document, you can get that from your broker. If you have an options account, hopefully you've already received this. They're supposed to send it to you. Or you can get it, you can contact the Options Industry Council, and they've got the address right there. We're not getting involved in the impact of taxes. If you make money when you trade options, you will pay taxes. Okay? And I'm going to try not to talk about any particular stocks. All right, there's always stocks that are in the news, and people will watch this a few weeks from now, and they'll go, "What's that thing about the Battlestar Galactica that they were talking about today that was going up in price?" But I'll try to use XYZ. I'm not promoting any stock. This is not a recommendation to do any particular strategy. It's just to try to make you more aware of how things work. Okay, so. Right, optionseducation.org. It's a great resource. Believe it or not, I have used optionseducation.org. There's 3 or 4 times a year where I will call them. Once or twice they call me, all right? But I will call them and say, hey, I just noticed something about XYZ. Well, what is that? Oh, that's a special dividend, or that's something that happened, whatever. So the investor service desk, very, very good people, okay? And they don't want to know you by your first name, but if you have something, don't hesitate. Okay, they're happy to talk to you. Okay, so here's what we're going to talk about today. All right, we've got another 55 minutes left here. We're going to talk about selling options. We're going to talk about selling call options, selling put options. Okay, and the reason people sell options is they're capturing premium, right? And it's not just capturing premium. I'm selling an option on XYZ for 50 cents because I'd like that. Remember, that's per share in each contract, and normal regulation size options. We're looking at 100 shares. I'm just not trying to make $50 here. This is perhaps a target point where I'd like to sell a stock. Okay, if I'm selling a put, maybe this is a target point where I wouldn't mind owning the stock. I have done both of these strategies within the last year, selling calls and selling puts. All right. The interesting thing here is that when you sell options, it's a wasting asset. Each day that goes on, we are one day closer to expiration. Whether it's this Friday or whether it's 3 Fridays from now or 6 months from now, each day we get closer to expiration, that option has 1 day less of life, doesn't it? Okay, we'll talk a little bit about assignment. That can be confusing, okay? And we'll talk about something called pinning a stock. I wrote a nice article years ago I think it was in the Wall Street Journal, about pinning a stock, and I'll explain to you what that is, okay? And I'm not a great believer in stocks getting pinned to a certain price, but I'll at least make you aware of the terminology, and you can watch it yourself and decide if I'm correct or not. And the Q&A, we're not waiting for questions till the very end. If you have something, fire it in. Let's see if it's something that the people in the background here want to jump in and give to me, great. And if not, we'll cover this as quickly as we can. So here's what we have, right? When we have call sellers, let's just go with this left column here. When you sell an option, first of all, it's an obligation. It's a contractual obligation to perform, all right? An option buyer has the right to do something, and it's their determination if they exercise that right. But a seller of an option, they are paid, but they have an obligation to perform if called upon to do so, okay? So the call seller has an obligation to deliver the underlying shares if assigned at any point in time. We'll talk about that in a few more slides, okay? Typical outlook, typically bearish. Now, you know what? Not always, okay? There's a stock that I own today, and I had 2 orders in. I had an order in to sell half of my stock at a certain price, a limit order above the market. I also had a limit order in to sell some call options at a certain strike price above the current level of the stock. And you know what? As luck would have it, both of those I got a nothing done on at the end of the trading day. Okay. Now, I wasn't bearish by deciding that I'd like to sell an out-of-the-money call option. I was just thinking that I've owned the stock. It did very well. It just had some wonderful news. The stock spiking up a little bit. I think this could be an area where I'd like to exit the stock. Okay. So the market outlook is not necessarily bearish. It's that, either you are bearish on the stock or you're trying to get rid of perhaps shares that you already own if you're a call seller. The benefits, obviously, you're bringing in premium. It lowers your break-even point, right? If we own a $50 stock and we sell a 55 strike price call and collect 75 cents and it expires, we get to keep that money. It's a taxable event, but theoretically, that lowered our cost basis down to $49.25, didn't it? Okay, so we're getting the lower break-even point. Okay, we can always buy the option back too, as it says, right? But still, the idea there is I'm obligating myself. If someone wants to take it away from me at a certain price, they can, and I'm getting paid for that. What's the potential risk? Well, it could be unlimited, and we'll talk about this too, about selling naked call options, which I'm not a fan of, right? Because if you sell a call option, obviously the stock could go to unlimited, all right? Now, I've never seen a stock go to unlimited before, but it certainly could, okay? The put, if you sell a put option, you have an obligation to buy the underlying shares at the strike price that you have chosen, okay? And you are on the hook. You have that obligation for the length of time you have until that option expires. What your outlook is, well, you're typically bullish. That's not necessarily true either, right? If the stock is at 50 and I sell the 47.50 strike price put, and I'll just use $1 to make it a round number, right? And if I were bullish on the stock, maybe I just go buy the stock or buy calls, right? But what I'm thinking here is I'd like to buy that stock should it back down to the 47.50 level. If it doesn't get there, I got to keep $1, right? I got to keep $100 before any transaction costs. If the stock goes below 47.50 and the stock is put to me and I am assigned, someone else exercises, right? I would own the stock at 47.50, but remember, I kept $1, right? I collected $1 when I sold that put. My effective break-even point, this is before any transaction costs, right, is 46.50, isn't it? Okay? So the idea there is I have an obligation to buy stock. Maybe it's at the level I'd like to buy it. Okay? The potential risk is substantial. It's not unlimited, right? A $50 stock, the lowest it can go is 0, which to me is unlimited, okay, but technically it's not. It can only go down 50 points, but it is substantial if you sell a naked put. If you decide to do this strategy, to sell a put to buy the underlying shares, make sure that you have a pull from your brokerage firm, okay, and you can contact them. They have 800 numbers. They're happy to talk to you, or you email them, and you can talk to them. And all you have to say is, if I decide to sell a put because I'd like to buy the underlying shares, am I approved for that? Okay? So that's up to you and your broker whether they allow that or not. Okay? Let's talk about selling a naked call. Not one of my favorite strategies. Okay? Here's a stock. We don't have the stock price, which is fine. Okay? It's the 50 strike price call, and it's trading at about $2. I don't think it's going above 50. Okay, so I'm going to sell the 50 strike price call and collect $2. Okay, my forecast is bearish. I don't want the stock going above 50. Or I'm expecting that the news just came out on this stock. The implied volatility, this is the expected movement of the stock, now that the news is out, is a lot less, isn't it? Okay, maybe the company had earnings, or maybe they announced their product and it was, wasn't well received, whatever the case was, but the news is out. The implied volatility, the pricing of the options, I expect should go down a little bit. Okay, so what's the break even on this? Well, if I'm wrong on the stock and it goes from wherever it is, 47, 48, if it goes up above 50, my break even is 52, isn't it? The 50 strike price plus the $2 that I collected by selling the 50 strike price call. And that's my break-even point. You can see that on the chart, right? What's my maximum risk? As I said, it's unlimited, right? If this stock goes to 55 or 60 or 70, I have an obligation to sell that stock at $50. I only collected $2. That's not necessarily good, okay? Because it doesn't really protect me, all right? Now, this next slide is selling a naked put. Okay, same idea here, right? Maybe the stock is trading at 52 or 53. I don't want to buy the stock right here. But if the stock were to get down below 50, you know what? I wouldn't mind buying the stock. So rather than put in a limit order to buy the stock at 50, I might sell the 50 strike price put. We're not real concerned about which expiration this is, right, in our examples. What do I have? I have an obligation. I'm getting paid. I just got paid $200 per contract, but I have an obligation to buy 100 shares at $50 per share if called upon to do so, if the stock is below 50 and I am assigned. My break even, because I collected $2, is the 50 strike less the $2 I received, so my break even is 48. I like selling puts. Okay, I do what is called a cash secured put. Okay. The idea there is I've got the cash. I don't mind adding the shares to my portfolio. Maybe I'm only doing this 3 or 4 times, right? If the stock is assigned and I'm on the stock at the equivalent of 48 now, remember the stock is backed up from 52 or 53. It's down below 50. I have the obligation to buy it at 50 less the $2. 48 is my break even. And what would I do? Many times I'll sell call options against it. Okay, where I do the covered right. But this is where if the stock doesn't get below 50, if you are not assigned, guess what? You get to keep $200. The option expires. You have no more obligation. The option is gone. Okay? So selling naked puts, the risk is substantial, but it could lead you into buying stock. And this is where people have asked me before, Marty, is selling a put risky or conservative? Well, I don't know if it's necessarily conservative, but would buying 100 shares at $50 be considered risky or conservative? Well, it's a good discussion, isn't it? If buying stock at 50 or having an obligation to buy it at 48, what you're giving up by doing this is, what happens if the stock goes from 52 or 53 and it heads back down to 49 in the next few weeks and it goes back up to 52 or 55 and now it's expiration Friday? If you sold this put, you do not necessarily control whether you were assigned or not. You can be assigned, okay, but you don't control whether you were or not. If you had the stock purchase in at 50, good till cancel. You bought it at 50, it went down to 49, but now it's trading at maybe 55, let's say. Okay, so you have the potential to give up some upside should the stock come down and then head right back up again. But I like selling puts to initiate a stock position. So I am happy about being assigned. I am happy about not being assigned, right? Because if I'm not assigned, I get to collect $200. If I am assigned, I am long the stock where I'd like to own it at $48. Okay? So here's what we have, right? Let's take a look at a variation on the covered call and the cash secured put. Okay? Covered call, right? I own the underlying shares, okay, and I sell a call option against the stock. Now it says simultaneously or already owned. Okay, that's what I was trying to do today, right? I bought stock quite a while ago at a much lower price. The stock has moved up. And I'm not a genius. So I won't tell you about the stocks that have moved down since I bought them, okay? But I thought I wouldn't letting go of the stock at a certain price. So I am now selling a call option against the shares that I own. What's the margin on that? There isn't any margin. You own the underlying shares, okay? So you're putting up your shares as collateral, right? And you are collecting money. And if you are assigned, your broker will deliver the shares that you have in inventory at their brokerage firm, okay? What's the objective? Generate income. And my objective was also to pick a selling price where I wouldn't mind letting the stock go by selling a particular call option. What's the market outlook? Neutral to moderately bullish. That's true. I want that stock to go up a little bit, okay? You know, where I would be assigned, or maybe it would go right up to the strike price and not be assigned. Potential benefits, I'm receiving the call premium plus maybe some appreciation in the shares from where it is right now up to the strike price. What's the risk? Well, the potential risk is not that the stock goes above the strike price and I lose out on just a little bit. The potential risk is the stock gets clobbered, right? Because I'm only selling an option and bringing in a small amount of premium to protect myself. On the cash secured put, right, what I'm doing here is, right, I'm selling a put, I'm setting aside the cash, it's in my account, I don't have to worry about it. You could also do this on margin if you wanted to. I don't use margin, okay, but I have an obligation if that short put is assigned. What's the objective? Well, it's one of two things, right? It's goal either to be assigned, and I want the stock at the lower price. To me, it's the consolation prize is the cash. If I am not assigned, okay, I got $200. It's not bad. It'll buy a couple of coffees, right? But I didn't get the stock that I wanted, but that doesn't mean that I can't go out and either buy the stock or continue to do this strategy again. Okay, market outlook, I'm still neutral to moderately bullish. You know, and I don't mind if the stock goes down a little bit. I'm still bullish, isn't it? Okay, I still would like the stock. You know, I don't want the stock to get crushed, but I have the potential right to buy the shares on a dip, and I'd be happy with that. The benefits, right, I get the premium, lower my break-even point if I'm assigned. The potential risk, as I said before, the stock gets clobbered, right? I have to buy the stock at the level at which I said I wouldn't mind owning the stock, but I have the risk of stock ownership below that level, okay? So why sell options? Well, as the slide says, it's income, right? You're getting a premium. You get rewarded. By incurring an obligation, you should be rewarded, okay? And it's either going to be that the option expires worthless, or maybe you can buy that option back, okay? I've done that before. I did that 4 or 5 weeks ago where I sold an option. I think I sold it a little under 50 cents, and I bought it back for 3 cents with about a week to go, okay? Did my outlook on the stock change? Not really. But when it got down to just a couple of pennies, you know, I go back to my trading days where I would think if I didn't have this position, would I sell this option today for 3 cents? And my thinking was, no, I wouldn't sell that for 3 cents. Why not just buy it back, put this option out to pasture, it did its job, okay? And I no longer have an obligation for the next week. You know, and crazy things can happen, right, after the close on any particular day. One of my stocks had news last week after the close that moved the stock. I didn't have an option position on. I just owned some long stock. So why am I selling it? I'm bringing in some income. And as I said, I've used selling options as a target point to either exit the stock by selling a covered call or to enter the stock by selling a cash secured put. Now, this is not on your final exam today. We're not doing the Greek test for you, okay? Theta is time decay. This is one of the Greeks. And just a quick review, the Greeks are all one of something. Okay, the delta, what if there's a 1-point move in the underlying shares? How will this option react? Theta is time, T for theta, T for time. How does time affect this option if we have 1 day of time decay? Okay, and I've seen different theta measurements, right? And as it says here, that this works for sellers, okay? But theta is, you can have a 1 day theta. I have seen what happens with time decay in a week. Okay, I have a 4-week option that I just sold theoretically, and what happens if the stock is right here a week from now? How much time decay should we get? Okay, now decay is per calendar day. It's not by trading day, okay? As it says here, that it represents the rent that the buyer pays and the seller or writer of the option receives. Okay, buyers want time to work for them, right? And the seller or writer of the option wants time to go very, very quickly. Okay, what the buyer knows is if they're buying an option, okay, today is a Wednesday, let's say, okay, and options expire in 10 days on a Friday, all right? If someone buys an option going out 10 days, they know that, you know what, at the end of the trading day today, we just lost 10% of our time, didn't we? It's not a 10-day option, it's a 9-day option. But maybe this stock starts to go up a little bit, okay, and the delta of the option, meaning that how the option reacts in conjunction and movement with the underlying shares, will more than offset any time decay, okay? So only time value decays, right? If we've got let's just say that we've got a 50 strike price call and the stock is trading at 52, all right? And with a week to go, the option is trading for $2.50. Excuse me, a nice round number, okay? If a day goes by, the only thing that's going to decay is not the $2 of that. The stock is the 50 strike, the stock's at 52. $2 of that $2.50 premium is real or intrinsic value, isn't it? The only time premium we have with that option is the 50 cents of time premium. All right, so if a day goes by and nothing happens and the stock is still trading right at 52, all that will happen is maybe that option isn't worth $2.50, maybe it's worth $2.48, $2.47, all right? We're making assumptions there. We're making assumptions that interest rates haven't changed, that the implied volatility, people's expectations on the stock hasn't gone higher or lower, right? So, when we're looking at these Greeks, we're usually looking at them one at a time, and it's always not quite that simple, is it? Okay. And what we're looking at here is time decay. We're a seller. That's what we're talking about today with options. We want that time to go very, very quickly. Okay. All right. So here's what we have today. Well, I just kind of went through this a little bit, didn't I? Right. An option's trading today at $3.50. Okay. And it's got theta of what? Where is the stock? Okay. The stock is trading at, I don't see where the stock is here. Okay. The stock is trading at, doesn't say, so there's theta of 50 cents. So that tells me the stock is trading at 53. Okay. So the contract is worth $3.50 times 100 shares, so it's worth $350. Okay. And if nothing happens and the stock is trading right here at $53 tomorrow, what we're saying here is that theta, and we can do this at the OIC website or your broker's website or the Miami Exchange website, you can take a look and you can do modeling, right? What happens if nothing happens to the stock? Well, the option should be worth closer to $3.47. Okay? 10 days from now, maybe this option is only worth $3.20, right? If we're looking at 10 days of time decay, maybe it should be about 30 cents worth of time decay. Okay? So what they're saying here is what you can always do is you sold the option. Okay, I'm sorry, you sell the option. Maybe you own the stock. You sold the option. You collect this money. Maybe you could buy it back. Right? You don't have to wait until expiration Friday. You're not obliged to do anything. Right? If you sell an option, you can always buy it back. If you own an option, you can sell it at any point in time. All right. I've had people ask me that before. Marty, what percentage of options expire? Well, technically all the options expire at some point, don't they? One way or the other, by either through expiration or by being assigned. But you know what? The more accurate answer is that 50 to 60%, I think, of the options positions are closed out before expiration. Right? Like my example, selling an option for 45, 60 cents, I bought it back for 3 cents. Why? It's cheap. I don't need the obligation for the next week. In this case, right, you've got this option trading at 350, nothing happens for 10 days, it's trading at 320, you can buy it back. Okay? And you no longer have an obligation to do something. So that time decay worked for you, not a lot, but it certainly did. This slide and the next slide, I think, are two great slides. It kind of gives you a visual, okay, of a couple of things. One, take a look at that bottom line that's kind of more straight. In the green type there says in the money option. That's an in the money or a far, far out of the money option. The time decay on deep in the money options or far out of the money options is more linear. Linear would mean this, right? If there's 30 days and it's got 30 cents a time premium, right, and it's deep, deep in the money, this thing's losing about a penny a day, isn't it? Okay? But if you take a look at the money option, that's the one that's higher with the curve on it. You've got the 30-day option. I don't have my arrow on this software, but you got the 30-day option, kind of ballpark where the 60 is, where the 90-day option is. Okay? That the money option decays a lot quicker when we get down to 30, 45 days. My general rule of thumb is I don't like to sell options for more than 45, 60 days. There are so many stocks and ETFs that have weekly options or they have, just the regular monthly expiration options. You've got a lot of choices, without obligating yourself for a long, long period of time. Okay? And the next slide really shows it to you. In this particular case, let's take a look at the 30-day option. Okay, and what I'm saying here is XYZ is trading at 50. It's an at-the-money call. It's got a 16% implied volatility. It's not real important for our discussion, but I just threw that up there. Okay, and what we have is, right, we've got the option premium, the at-the-money option, 50 strike price call, is trading for $1. Okay, the theta, it's going to lose about a penny and a half a day, or at least that first day it will lose a penny and a half. Maybe that second day it loses more than that, right? This is where, if you're trying to decide which expiration, and you can do this with the regular monthly expirations, you can even kind of figure out how to do this in your head with the weeklies. Take a look at the 60-day option trading for $1.47. It's only got 1.1 cent of theta per day. Look at the 90-day option for $1.71. Okay, this is a stock, there's no dividend, and I'm assuming interest rates are the same, and the implied volatility is the same all the way through. Okay, we're less than 0.9 of a cent of time decay. But look at this differently. Okay, you and I both own the same stock. We're going to do a covered right. We're going to sell the at-the-money call. Okay, you sell a 30-day option, you collect $1. Good for you. Okay. I sell the 90-day option. I collect $1.70. Hey, Marty's a pretty smart guy. He just collected a lot more money, right? 70% more money. I can do the math on that, right? But look at this. 30 days from now, let's just assume that the stock doesn't go anywhere and your 30-day option expires worthless. You just collected $1, okay? I don't own or I don't have a position being short the 90-day option. I am now short the 60-day option. Guess what? It's trading for $1.47. It was the same stock. It's the same implied volatility. It's the same 30 days that transpired, isn't it? But look at this. I only lost, 24 cents on the option that I sold. Okay? So if I am a seller of an option, would I rather sell the 90-day option and collect $1.71, or would I rather sell the 30-day option, hopefully 3 times, And I'm oversimplifying this, as you can imagine, right? But if I could collect $1 3 times, that sounds like $3 to me. Okay, now 3 commissions. Okay, if I'm paying commission to my broker. Okay, but I get that time decay working quicker. Same idea. We're not doing the presentation on buying options, but just if we were for a second. Okay, would I rather buy the 30-day option for $1 or buy the 90-day option for $1.70? Think about that, right? I think something's going to happen in XYZ. Okay, and I'm pretty bullish on this stock. Okay, the snow will melt someday in Chicago, and XYZ should go higher. Okay, look at this. If I bought the 90-day option for $1.71, and nothing happened for 60 days, I would now own the 30-day option for $1, wouldn't I? You see that? Guess what? I just lost 71 cents. The person who bought the 30-day option lost $1 that first month. Okay? I owned the 90-day option. I held it for 2 months. I can still get $1 back for that option. So I'm going to back up one slide here, right? If I'm a buyer of an option, I'm on the curve with the at the money here, right? I'm going to give myself just a little bit more time. The incremental cost is not that great, okay? If I'm a seller of an option, maybe I'm not selling the 90, maybe I'm selling the 60 or 30-day option, okay? Right? And, you could do it with the 60-day option. You could do it with the 90-day option, okay? So the whole idea here is, you know what? If we're trying to make theta or time decay work for us with options, and you've got your mindset on, Marty, I'm thinking of selling that the 3-week option and collect $1. You know what? The 2-week option might be going for 85, 88 cents. Would you like to cut your time obligation by a third and only cut 12 or 15% off the premium you're collecting? Okay, we're moving to the right on this graph, aren't we, as a seller? Same idea with the buyer. We're going to the left. Okay. So what happens with implied volatility? And this is where you see implied volatility. Companies have earnings after the close, right? The whole world knows that earnings are coming today, all right? The implied volatility or people's expectations have been going up in the possible movement of the stock. Higher volatility does not mean that we're bullish or bearish. The implied volatility or the cost of the options is going up on both calls and puts together, okay? Now that the news is out, the stock is going to do what it's going to do. It's up a little, it's down a little, it doesn't do anything. But you know what? The news is out, the implied volatility comes down, right? As implied volatility goes up, that first little arrow, the first area there with the green arrow, as implied volatility goes higher, you know what? Both call and put options will increase in value, okay? If calls are going up, puts will go up as well, all right? As implied volatility decreases, the news is out on the stock. It's going to make a move a little bit, but the cost of the options will go down in value. It should decrease. Here's what I do if I were handing out a homework assignment, and I never did like homework as a young student, so I'm not going to do this. But you could do this. Pick a stock that has earnings later in the week, and take a look at the implied volatility of the at-the-money option. Okay. ABC is trading at $60 right now. Okay, take a look at the 60 calls and 60 puts. Take a look at the implied volatility. The software at your broker's firm or the OIC will tell you the implied volatility, right, of those options. And take a look. The earnings come out, whatever. Next week, take a look at the implied volatility of those 1-week options. You'll see that the implied volatility should be a heck of a lot lower on the at-the-money option. Don't look at the same strike price unless it hasn't moved. Look at the at-the-money option. You'll see that the implied volatility on the options is down. Okay? A couple of weeks ago, there was a stock. They make electric cars, right? The implied volatility was crazy. It was so high, I was feeling, I'm not going to tell you bullish or bearish, all right? the implied volatility was out of control. I looked at a couple of different strategies. The only one that made sense to me was kind of a convoluted multi-leg strategy. I decided too complicated. I'm just going to back off and let this thing do what it's going to do. And it did what it was going to do, okay? Wallace has some questions. Well, you know what, Wallace? If they're good questions, we're going to get to them. Don't worry. I'm not ignoring you, okay? All right. And if one of my cohorts wants to pass along any that they think I should slow down, and we'll do it. And if not, I'll cover these at the end. So the implied volatility expectations will affect the option price. You'll see this sometimes where I've seen this where people say, hey, Marty, this option's trading at $3 and the stock didn't move and now it's trading at $3.10, okay, or $3.15 or $3.20. What's going on? Theta, time decay is kicking in. Yes, but the implied volatility is moving higher. Okay, the company's making announcements, right? Maybe it's the supply chain out of China or whatever, okay? You just don't know what people's expectations are. There's a lot of uncertainty on the stock, okay? So here, this is something important to know, the exercise style. All stocks, all ETFs are what we call American-style options. What that means is this. American-style options can be exercised at any point in time for any reason, okay? So if you have sold an option on a stock, ABC, all right, and it's what we would say in the money. Same thing could happen with a put, right? But let's just use the call for the time being. You sell a 50 call and the stock runs up to 53. Someone could exercise that at any point in time for any reason. You do not control whether you are assigned or not, okay? If you do not wish to be assigned as we get closer to expiration, or equally important, we get closer to when the stock goes ex-dividend. If you don't understand that term, you should. Look that one up. Write it down and look it up. This is the date at which shareholders, as of this date, are entitled to the dividend. People that buy the stock tomorrow are not entitled to the dividend, okay? But people will exercise call options the day before the ex-dividend date if they are deep in the money, so they get the dividend. Okay, if you do not want to be assigned, you can close out that position during regular trading hours. Okay, European style on the right there, most indexes, most larger indexes are what we call European style. European style says they may not be exercised before expiration Friday. So if you have a position in a European style index, you cannot be assigned before expiration. You don't have to worry about that. Okay? But the important thing here is for people that are selling options, right, that if it's on a stock, whether it's a put where you'd like to buy the stock, you're doing it covered right, it's an American-style option. People can exercise at any point. When do they? If it's not at expiration, the call option the day before the dividend, a deep-in-the-money put the day after the dividend. Okay, I'm short a 2-month put, the 50 put, and the stock is trading at 42. Okay, you know what? Someone that owns the stock and owns the put might wait until the stock goes ex-dividend on Friday, and then they will exercise their put and give me the stock. Why? They're looking at, then they don't own this option position in maybe long stock until expiration 60, 90 days from now. They give me the stock. They get cash, don't they? I have to buy the shares from them and give them cash. So American style, all stocks, all ETFs, American style, you can exercise or be assigned at any point in time. European style, major indexes, and you could go to the website of where that index trades and look it up. Is it American? Is it European? They will tell you, and probably most of the major indexes are European style, okay? So implied volatility, what can it affect? Well, it affects a lot of things, right? As the market goes up, the implied volatility has a tendency to go down. Why? Complacency. Okay, as the market goes up, the market was up today, you know what? I would think that the implied volatility of the marketplace, there's a couple of measurements of those, right, are down a little bit. Why? There's no need to buy puts. The market's going higher, isn't it? Okay, well, until it doesn't, all right? And there are people that are buying call options because they think the market's going higher or their stock is going higher, okay? So what happens is, as the market goes higher, the general tendency, not all the time, the general tendency is that the implied volatility of stocks and ETFs and indexes goes down, okay? If there's a sudden move, okay, something happens on the world stage or with this coronavirus or whatever, you know what? All of a sudden, the implied volatility can jump. There's a great deal of uncertainty, okay? If there's a drop in the market, guess what? The implied volatility has a tendency to move higher, right? You can consider this almost as insurance, right? Do you need hurricane insurance in Florida if the weather's calm and everything's wonderful? Not really. Now all of a sudden we're in hurricane season, and these hurricanes are lining up through the central Atlantic there. You know what? The hurricane insurance might go up a little bit in price. Why? Because there's more uncertainty, right? So a drop in the market, generally we have an increase in implied volatility. Okay, it says here, unfortunately, panic is often more impressive than optimism. Well, I get to panic. I've panicked before, okay? So anyway, there's a lot of factors that affect the implied volatility. Usually it's a company's corporate announcements, it's maybe a competitor, it's what's going on the world stage, it's something going on with their supply chain, okay? And the change in implied volatility, that it could go higher, it could go lower, but it's certainly unexpected, isn't it? Okay. So what is assignment? Let's go through that assignment real quick, okay? Assignment is this, right? So the option seller has an obligation to sell for a call or buy for a put, right? So they have the obligation to do something with 100 shares of the underlying stock if he or she is assigned, okay? So what happens here is you sold an option to me, okay? You didn't sell it to me, and I didn't buy it from you. We both traded with the Options Clearing Corporation, part of the whole OIC. They guarantee all the trades, okay? So I bought an option from you, and now it's gone. In your let's call it a call. Your call position is in the money. You don't have to worry about me. I might have sold that option 2 days later to some lady down the street, okay? But let's say some other person down the street decides to exercise an option. It is a random process where they kind of reach into a bucket. If someone exercised that option today, tonight, in the middle of the night, they reach into a bucket at the Options Clearing Corporation, okay, and they pull out a name, and the winner is you. You are just assigned, okay? It's an irrevocable assignment, okay? You were assigned today, Wednesday, and you're going to find out about it tomorrow, Thursday. It's irrevocable, okay? So you have an obligation to deliver the shares if you sold a call, or you have an obligation to buy the shares if you sold a put, okay? So let's take a look at the example, right? XYZ is trading at 79. Somebody sold the March of 2019. We need to update that slide, okay? 80 call at $1.50, okay? And all of a sudden, hey, this stock's trading at $84, okay? And the seller is assigned, okay? So it's the 80 call, stock's at 84. You collected $1.50, okay? What's happening here is you have an obligation to deliver the shares, and you will get $8,000 pushed into your account automatically once your broker is informed and the money changes hands. You don't have to get involved in that. It's kind of seamless. And you deliver 100 shares, and you collect $80. Now, you collected $1.50 when you sold that option, okay, which is fine. So you are effectively selling that stock at $81.50. It says here, right, that you have a loss because in this case you have sold this option naked. You thought there's no way this stock's going higher. It's not going above 80, that's for darn sure, and I'm protected up to 81.50. Well, as of tomorrow morning, you're going to walk in and you could find yourself short 100 shares of XYZ. It's trading at $84. You've got a $250 paper loss on your hands, don't you? And you have considerable risk. Okay, some people might say it's unlimited risk to the upside should something wonderful happen to that stock, before you can close the position out. Okay, I'm going to come back to this in just a second because I'm going to talk about example number 2. This is where I bought 100 shares at 75 and I sold the 80 call at 150. Stock's trading at 77, 78. I wouldn't mind getting out of the stock at 80 or higher. You know what? The stock goes to 84 and I'm assigned. I deliver my stock at 80. I collected $1.50. So I effectively sold that stock at 81.50, didn't I? Well, it's too bad. I should have hung on to it, right? I left a little bit of money on the table. But you know what? I bought it at 75. I sold the stock at the equivalent of 81.50. That's about 8%. That's not so bad, okay? I made $650. Okay, I no longer own the stock. I no longer have an option position because it was assigned. All right, so I was assigned. My stock is delivered. I'm gone. Okay, I'm going to back up here. The person that sells the call option naked, they have unlimited risk. You know what? I have approval from my brokerage firm to sell naked calls. You know what? I don't do that. I don't sell naked calls. I don't like the idea of unlimited risk. Okay? What I do is I sell call options against the stock I own. Now, as I said today, I got a nothing done on I own shares. I picked a strike price. I wouldn't mind letting the stock go. I picked a premium that I thought would be reasonable for me. I laid it out there as a limit order. I got nothing done. I'm okay. All right? I can do this tomorrow. Okay, taking the dog to the vet tomorrow. So we'll put this on and let's see what happens. Okay, but this is called the covered right. The option I am selling is covered by the shares that I own in the underlying stock. Okay, pin risk. Pin risk is this. Okay, pin risk is, I think it's just as easy to show you the example. Okay, when the stock seems to gravitate to a certain point, okay, where it's going to leave you the most pain. What's going to happen to my position? Okay, you have to be aware if you're a seller of an option as to what's going to happen here. And let's take a look at the example. Okay, somebody just sold the expiring 270 short put. Stock's trading just above 270. Okay, well, you know what? If it's trading at 270 and a quarter, okay, you know what? I sold the 270 put. I have an obligation to buy the underlying shares at 270. I would expect that I wouldn't be assigned, right? Here's the deal. You don't know that. Okay? What happens if there were last week there were 3 stocks that I won't name the person, but he has a wonderful little house and an old truck out in Omaha, Nebraska. He initiated a position in 3 stocks and this position was released on Friday after the close. You know what? Maybe those stocks ran up, okay? Maybe there could be news on this particular stock, after the market closes and, but before the Options Clearing Corporation locks their door and says no one else can do anything with exercise of calls or puts, okay? You just don't know what's going to happen. And I think that the misconception is that investors think that, well, you know what, XYZ is trading near 80. The traders want to push the stock to $80, okay, because then all the options expire, don't they, okay? In reality, what happens is that's the last spot the traders want the stock to go because they don't know will they be assigned on call options, will they be assigned on put options, will there be news after the market closes on Friday of expiration, right? So the idea here is that don't assume that there are services out there that say, well, you know what, the XYZ is trading at $265. There's going to be a big push to move the stock up to 270. That's not the way it goes. Okay, that pinning is something, and I've written articles on this before in papers, right? That sometimes it seems that the stocks gravitate to a nice round number. Sometimes it doesn't. Most times not. There's no magnet pulling them to a particular spot. So just be very, very careful that there's no way that the stock's going to be assigned. I sold the 32 strike price calls on XYZ, and the stock's trading at 31.80, 31.90. There's no way anybody would ever exercise those 32 calls. You don't know that. Okay, and this is a very good example of, you know what, buy that option back for a penny or 2 or 3 cents. Okay, and you no longer have an obligation, and if something crazy happens and the stock does kind of get pushed to that strike price, you're not involved there. Okay, right. So the only way to avoid assignment, right, whether it's pin assignment or any assignment, is not to have the position on anymore. Close the position. Okay. It should be possible to close out an out-of-the-money position for very little cost prior to expiration. As I said, on a Monday, and it was a Friday expiration, this is a few weeks ago, I closed out a short position for 3 cents. It was out of the money, but you know what? I just thought, I just don't need to be worrying about this position. Not only that, I can't do anything else with this stock. If I have this position on, I can't do it again. I can't sell something going out 2 or 3 weeks, because then I would have naked positions, and I don't like to do that on calls, right, on covered calls. Okay. Buyers have until their brokerage firm cutoff time to decide whether to exercise. Here's how that works. The bell, I'm on Chicago time, right? The bell closes at 3 o'clock in Chicago, 4 o'clock New York, 2 o'clock if you're on the Pacific Coast, right? Stocks can cease trading in their primary market, but what happens is the Options Clearing Corporation has a time where they lock the door on Friday afternoon of expiration. They don't let anybody in after that news. So what does your broker say? Well, if you own this option, you might have until, I'm just going to make this up, okay? You might have until 3:45 Chicago time to let us know that you would like to exercise by exception, okay? The stock is trading at 31.90 and I own the 32 calls. I want the stock, over the weekend or a long weekend. I'd like to exercise my 32 calls. They'll do it, but you have to give them time to get over to the Options Clearing Corporation before they lock the door. So the same idea if you're a seller. You don't know if anybody's doing anything after hours, okay? And if it's that close, if you're real close to the strike price and you don't want to be assigned, close it. And if you are assigned, you might be scratching your head and go, why would anybody want to do that? Well, they have the right, don't they? It's an American-style option. They can do that at any time for any reason, okay? As I said, there could be data release like that Omaha last week that decided to whatever Q that was. It was the fourth quarter report. It's 45 days old. He told people what his positions were in a couple of stocks, and these stocks were moving, weren't they? Okay. So you could be at risk of early assignment based on the dividend, but you could also be at risk because there is news happening and you just weren't paying attention. Okay. So quick, this is a one-question quiz. We're going to get to some of the questions. Okay. Somebody says stocks typically go low on the options expiry day. If so, is it better to close the position on Thursday? There's no set pattern as to what stocks do on expiration Friday or expiration day. So I would say, I'd like to put in limit orders to close my position at the price I'd like to do, and if it gets there, wonderful. Okay. Here's the question for you. If you sell a 35 strike price call, what is the obligation incurred by the seller? Well, it's pretty simple. Okay. First off, we know we have an obligation because we sold an option. We got paid, and that's good. Okay. What is our obligation? The obligation is, if we are assigned, we have an obligation to deliver the stock at $35 per share, don't we? Okay. Now, is that the point where we're tickled to death to get rid of the stock at $35 plus whatever the option premium was? Or is that just a premium we were trying to collect and we really don't want to lose the stock? We've had it forever. We have it at a very low cost basis. I really don't want to lose the stock. If that's the case, if it gets close to expiration, I close it out. But you do have an obligation, as long as you have that position open, you have an obligation to deliver the underlying shares. Okay? So I'm going to go back to that one question, and then we'll see if Mark or Bill have any other questions for me. Do you experience Friday selling? Stocks typically go lower on expiration. Is it better to close the position on Thursday. No, there's no right idea. I'll close that position anytime I want. I've sold options for $2 and closed them at $1.50. Okay, but when we get down to expiration, you just don't know what's going to happen. Fridays we have a lot. Many times we have, the employment report once a month. We have other economic data coming out. We have not only your stock, but could there be a competitor of your stock that has an announcement? Sometimes you'll see that at, conventions and expositions, like the computer things in San Francisco, where all of the computer people are talking. Well, it might not even be your company. It could be a different company that moves your stock because of their news, right? So I'd say that there's no right day to close an option position out, long or short. Just pick a level at which I just don't want to wait until 2 minutes to go on expiration Friday and then I get panicky. I get out long before then. Mark, did you see any other questions that anybody had, or Bill?
Yeah, Marty, I just chatted one over to you. When you sell the option as part of a vertical spread, how do you measure theta and determine time decay for the position as a whole?
Okay, so the question is, right, I sell an option as part of a spread. A vertical spread means this, okay, I buy the 50 call and I sell the 55 call. Okay, I have the right to buy the stock at 50. I have an obligation to sell it at 55. How do I measure theta? Well, what determines time decay? If I have a position on where I'm long an option and I'm short an option, I usually take the net amount. Okay, so I'm long an option with a delta of 50. I'm short an option with a delta of 20. I'm saying to myself that I have a net position of I am long delta 30. The stock goes up $1. I should theoretically, at least initially, have that position work for me for about 30 cents. Now the deltas change, right, as we go further in the money. Okay, this is gamma, right? Now we're into other Greeks, okay, where the delta changes and now it's more than 30, okay? But I take a look at a net amount, okay? The time decay, same thing. You can add the two time decays together. The 55 call I sold is working for me. The 50 call I bought is working against me. I'm probably going to have a slight negative theta. It's going to be working against me because I'm long a vertical spread in my example. Okay, but I just net out. I'm sure there are fancier ways to do it, but to me the simpler way is usually the easiest way. Okay, I just take the net delta to see if I'm long or short. I take the net theta, okay, to see if this is going to help or hurt me as time progresses, okay, and how that would affect as we get closer to expiration.
All right, Marty, we've got time for maybe one or two more. I know that you
Sure.
Mentioned selling calls, especially covered calls, for example, long stock, short call, and there's an upcoming dividend. Can you expound a little bit about how investors can determine whether or not they're at risk of early assignment with that dividend?
Absolutely. Okay, so I own a stock. I bought it at $25. I sell the 30 call, and the stock is going ex-dividend tonight. And this is an option that expires in 2 or 3 weeks. The stock is trading at 31, so it's in the money. Okay? Will I be assigned? Well, I can't tell you that definitively. We're only going to know, it's 3 weeks to go. We're only going to know when we find out when the Options Clearing Corporation tells your brokerage firm and they tell you that you were assigned. One of the things that you take a look at there is, I'm looking at two things, okay? I'm looking at, what is the delta on this option, okay? And, if the delta is only 60, 70, I don't think I'm probably going to be assigned. The other thing I'm looking at, this will seem kind of counterintuitive to you. You're looking at the call option. You know what I do? I take a look at the put. What is the put bid? Is there a bid for the put? If there is, it shouldn't be assigned. The other thing that's happening is that, right, I'm short the 30 call and the stock is trading at 31. It's $1 in the money, but the 30 call is trading for $1.25 or $1.50. There would be no reason for someone to exercise that call option. Okay, if they owned the call and they wanted the stock, if they exercise the 30 call, they're effectively paying $1.50 for it, aren't they? If the option's trading for $1.50, they're better off buying the stock at 31 and selling the call collecting $1.50. They're net bringing in 50 cents. So is there time premium in the option that I own? Is there time premium in the puts, the corresponding put of that stock? Okay, and then I'm looking at the delta. If the delta isn't up, in the 90s, I don't think that I'm going to be assigned.
All right, Marty, thank you. It is now 4:30, so Marty, thank you for sharing your knowledge with us. A lot of questions came in, a lot of great questions that Bill and I were able to answer, and you certainly answered a lot of them throughout your presentation, so thank you for that.
Boy, it went quick, didn't it? This time goes quick when you have a good subject and some good questions.
It sure does, and one thing we do love here is talking about selling options. Very, very popular strategies and definitely a tremendous amount of interest. And ladies and gentlemen, if we didn't get to your question directly, we will be responding to it tomorrow. Any future questions that you have, feel free to reach out to the Investor Services team at options@theocc.com. Visit our website as well, optionseducation.org, for future presentations. We do the webinars twice a month, and I know Marty had mentioned it earlier, but in the upper right-hand corner of your screen, you can download a copy of today's slides, and then also, as we end the presentation, make sure that you take a moment and fill out the survey. Let us know what you thought of the event and any suggestions for future topics. So, Marty, again, thank you for your time. Much, much appreciated, and always
thank you, Mark.
Always a joy to hear your experienced and legendary take on the options world. Ladies and gentlemen, again, thank you for joining us. We know that there's plenty of things that you could be doing with your time, so we certainly appreciate you sharing it with us. All of these events are recorded, including this one, so you can replay the presentation at any time using the same link that you used to join us. And again, any questions that you have, let us know at the Investor Services team. Have a great evening, everyone, and we hope to see you soon. Bye.
Thank you, everyone.